Hi, and welcome to another episode of Danny Brown Talks Phoenix. I'm your host, Danny Brown, and in this episode, we are talking to Garret Cerkvenik with JFQ Lending, and this series is Ask a Lender. So welcome to the show, Garret. Appreciate you taking time to come here today.
Of course.
So first, I wanted to start and how does someone go about choosing a lender?
Well, a lot of people think that they're looking just for price when they're coming to a lender. Who's going to give me the best deal? But there's a lot more than that goes into it. Because somebody can offer you the best price up front and not deliver on that. Also, you really get what you pay for. So you want to work with somebody that you trust, somebody that's got a great reputation, in the purchase world or, in the refinance world as well, somebody that's going to get the deal done. Because, unfortunately, with a lot of lenders and a lot of larger retail banks, especially, you've got a lot of inexperience. And so, you can be working with somebody that may not be qualifying you right up front. That may not be pricing it out up front, may miss, something in there, and, you're going to pay for it at the end. So you really get what you pay for. And, in that case, I don't think you should always go with the cheapest. Go with somebody that's got that reputation and, somebody that, has a proven track record of doing right by their clients.
So you touched on a couple of really good points, I thought, right there. Trust being the first one. Buyers, people are going to be giving a lot of financial information to the lender that they choose to work with and divulging a lot of information about themselves to this person.
Yeah.
So I think trust is huge. The other one that you talked about, the other point that you made was that you get what you pay for. So do some lenders hide fees when they're pricing things out to make it seem like they're cheaper than they actually are?
In some cases, yes. Somebody could, for instance, a cash out loan will price out differently than a rate and term loan or a purchase. So, and lenders really control what they disclose in a lot of cases up front. So, if they're pricing it out one way and they miss something like that, or, they are pricing it at a higher loan amount or with a higher appraised value, things that really impact pricing, those things will change at the end when you get down to it, and then your numbers will change. And so the deal that you thought was great up front may not be the great deal that you thought you were getting. A lot of times, there's a loan estimate that comes out, that's standardized between lenders. So you can really see a lot of the fees that are being charged. You have to disclose a lot of that stuff up front, but there are ways to get around it. You can send out a loan estimate that's not locked, for instance. So, then you're really subject to the market by the time you get to closing. And if rates have gone up, or if they, decide they want to charge you more, they can. And, now you've been in process for 30 to 60 days, and the option is to start over with somebody else or just to close. And unfortunately, a lot of people bank on you just closing it up and saying, I just want to get this done. So,
wow.
Working with somebody that you trust and that's going to tell you everything up front is important.
So you also mentioned that lack of experience can take place at some of the bigger banks. Do the individuals that work at the bigger banks, do they have to go through the same licensing requirements that you guys do?
They do. So everybody has to be licensed to originate a mortgage. So it's not necessarily licensing. It's more so just, missing things. Somebody may look at a pay stub that, for instance, the buyer, made $5,000 in that pay period, and they'll say, okay, this client makes $5,000 every 2 weeks, but what part of that might be is a commission, and maybe that person, the buyer or the client, has only been receiving that commission for 6 months, so a lender can't use that. Now, when you get to closing, or after that income is verified, we can only use $3,000 a month. So you may not qualify for the home that you're looking to buy. You may not qualify for the refinance you're looking for, or even the program that you were doing up front. So, experience definitely helps, being able to evaluate somebody's overall financial picture, because there's a lot to it, and there can be a lot to it.
Sure.
So that's, I think that working with somebody that, has that experience and has done a lot of loans and, really knows what they're doing is important.
It sounds like by having that experience, they can save you a lot of possible heartache and headaches down the road.
Absolutely. And save you a lot of money as well. You might, you might lock in with somebody that, gives you something great up front, and then the market could go up a quarter or a 0.5%. And then if you get to the end and they can't qualify you and you've got to go somewhere else, now you're subject to that new market, and, paying a 0.5% on a $200,000 mortgage might cost you an extra $40,000 in interest over the life of the loan. So it can really be an expensive mistake.
That's a big error.
Yeah.
So you had talked a little bit before about a good faith estimate. So what should, I go and I apply for a mortgage and the lender issues me a good faith estimate. I've never seen one before. What are some of the things that I should look at on there when I receive one?
So it's technically called a loan estimate these days, and they're standardized. So all of them look the same, which is nice. The government, put that in place to where, everything is the same. So you can really compare two lenders' offers.
Apples to apples.
Apples to apples. It's going to have some important pieces of information. Number one, it's going to show whether or not your rate is locked. Because if it's not, the fees that they're disclosing, points and things like that can change. So you want to work with somebody that's able to lock in your pricing. Number two, it'll show what appraised value they're using. One of the big things that impacts your numbers, your rates and your costs, is the value of the home. So you could have somebody that's overinflating something to get you under a specific threshold. If one lender is estimating your value at 200 and another's at 250, this lender is going to give you better pricing simply because of that.
How do they get an estimation of value for a home if you just are shopping for lenders and don't have a home picked out yet?
So on the purchase side, that's going to be a little bit different. That's more on the refinance side, is, what they're estimating the value is. And ultimately that'll come down to an appraisal. On the purchase side, when you are buying, it's all about your down payment. So that should be pretty consistent, when you're shopping. The other things that a loan estimate's going to have are, what the lender's origination is. If you're paying points, what the, all of your third party costs are, what they're charging for an appraisal, things like that. The other thing it'll show is how much they're estimating for your new escrow account, which is your taxes and your homeowner's insurance. So you might have a lender saying, okay, we're only going to put 2 months of taxes and insurance in there. Another lender might be actually pulling that information from the county to see when the tax dates are and estimating 12 months. And that will impact your overall number, but it doesn't necessarily mean one lender is better priced than the other. It just means this one's being a little more accurate up front. This one may be hiding some of those figures until closer to the end, where they may come up.
How does a buyer know if a lender's hiding some of those fees?
Again, a lot of times buyers don't. So we'll have folks that will compare loan estimates, or they'll tell me, oh, we're going to go with somebody else because they're giving me a better deal. I always encourage them to send me the loan estimate they're getting.
That's a great idea.
That way I can sit them down. I can show them what the differences are between mine and theirs and say, listen, as you can see here, our costs are cheaper. Their cash out of pocket seems lower, but that's because they're underestimating over here. So, it's important to compare, but again, it all comes back down to who you trust, because one lender may tell you that their numbers are better and they may not be.
Sure. So tell me a little bit about mortgage insurance, or it's often referred to as PMI.
Mm-hmm. So PMI, is on typically on any loan that has where you have less than 20% equity. Excuse me. So an FHA loan always has mortgage insurance. It's one of the downsides to FHA. No matter what your equity position is, if you put 20% down on a home, you're going to have mortgage insurance with FHA. It's on there for a minimum of 11 years, sometimes on the life of the loan, depending on what your down payment is. With a conventional loan, if you are under 80% of the value, you have 20% equity, there's no mortgage insurance. But there are ways, even if you're not putting that 20% down or have that 20% equity, to waive it. We actually have programs where it can be waived with as little as 3% equity.
Wow.
Typically, you have to have a little bit higher credit scores, and typically the rates are going to be a little bit higher, or the costs. You're going to pay to waive it, but you won't have that monthly amount built into your payments. So that gives you more buying power, reduces your debt to income ratio, and might give you a payment that is more in line with what you're looking for on a higher priced home.
So you mentioned a couple of different loan products there. What is an FHA loan? What's a conventional loan?
So FHA is a Federal Housing Administration. It's a government loan. Well, they're all kind of government loans these days. But FHA is great for first-time home buyers, folks that have lower credit scores, smaller down payments. It typically has a little more flexibility with pricing as far as interest rates and debt to income ratio, and gives people a little bit more flexibility than they would get with a traditional product like a conventional loan. Conventional loans, typically require higher credit scores, to get better pricing. You have to put a little bit more down, not much. You can do as little as 5% down on a conventional, or 3% in some cases.
Wow, 3%. I didn't know
that. And there's even programs with less than that. So that's typically the minimum, but there's some oddballs out there. And conventional programs are, they're great. They both have their merits. I would say most home buyers that are looking to put as little down as possible and may not have a ton of money in the bank or the credit score that you would typically want, you would probably want to go FHA. They're going to get better pricing in that program.
So what are some of the minimums then for FHA and conventional financing?
So conventional, you have to have a 620 credit score or higher.
Okay.
Ideally,
620 is pretty average.
That's pretty average.
Yeah.
Ideally, you'd like to have a 720 or higher for it to really make sense. FHA loans start at a 500.
Wow.
Yeah, it's low.
You can have, made some pretty big mistakes to have a 500 FICO score.
Yes. But, keep in mind that just because you have a 500 credit score doesn't mean you're going to get qualified, because there is a whole list of conditions that come along with that. Having to explain every delinquency in the history of your credit, having to get, a rent history from 2 years of from your landlord. There's just a lot that comes with those lower credit score loans.
I feel like though that most people will pay their bills on. Most people are good people,
yes,
and they want to pay their bills on time. But there's usually something that happened during a period of time that kept them from being able to pay their bills. They may have gotten sick, they lost their job. So can that one, you're saying you have to explain every single delinquency. Can that be your reason for every single delinquency? I lost my job for the 6-month period, and you can see I stopped making my payments because I didn't have any money.
100%. I just had a client that we closed last week on a purchase, 580 credit score, so not the worst, but not the best. And she had lost a job, back in 2014, and that's where all of her delinquencies were. So she was able to explain that. It's just a simple letter of explanation, and there's a lot more that comes with it. Having to there's just, the bank statements are going to be looked at a little bit more if there's any non-sufficient fund fees. Everything's just looked at with a little bit bigger microscope at that point.
Sure. Who is looking at these things? You've mentioned that they're going to be looked at under a microscope. Is that you looking at all this stuff?
So yes and no. I'm looking at it up front, because what I don't want to have happen is to give a buyer, a pre-approval, or get somebody in process on a refinance that I don't think can qualify and close. A lot of this industry, is built on, a lot of lenders work on loans that don't actually end up coming to fruition. Some of the big retail banks close 70% of their loans that come through, which is unfortunate, because, you give somebody hope of buying a house, and, they get into process. They're in process for 30 to 45 days, and they get to the end and they're told that they can't qualify. So I'm the first kind of line of defense there. I'm going to look at their income, their credit, their assets, everything like that. So I can at least get a good idea of whether or not I can make this thing work, and set the right expectations with what they're going to need to do in process.
Sounds like that's like the true definition of a professional versus a salesman who's just there to take the application, feed it off to somebody else, and then go on to the next guy.
Absolutely. And then after that, it goes to an underwriter. An underwriter is there compiling a list of conditions. So saying, okay, you had this, this fee in your bank statement from 2 months ago. Explain where that came from, or explain this deposit. So, they are there. They're the ones that will ultimately be approving the loan, and saying, okay, this is good to go. It's approved. Let's get it, closed. So 2 steps in the process of qualifying.
Gotcha. So what are some of the maximum limits for FHA and conventional financing in terms of how much you can borrow to purchase a house? If I'm a first-time home buyer and I've got a cushy job, can I get a FHA loan for $500,000?
You can't. So, there are county loan limits for FHA. So, for instance, out here in Phoenix, obviously Maricopa County being the largest, it's $272,000 right now. Actually, well, that just went up a little bit this last year. So, you can't go and buy a $500,000 house and use the FHA program. Conventional loans, the conventional loan limit out here is $453,000. So you can buy up to that, and then we even have some programs that will allow us to go up to $679,000 without the program being considered what's called jumbo.
Okay.
So in some counties in the country, mostly in California and a few other states, they have expanded loan limits that keep you out of a jumbo program because jumbo has far stricter requirements. So, we have options that will allow you to buy up to $679 in Maricopa County.
Wow.
Without having to, meet a lot of those extra, steps to be able to qualify.
Sure. So if I'm shopping for a home in, say, Arcadia or Scottsdale, it's pretty hard to find a home that's under $679 in some of those areas.
Yep.
You've mentioned jumbo loan several times. Mm-hmm. What does that look like for a buyer?
It's going to be larger down payments. A lot of times 15 to 20%, better credit scores. You usually have to have at least a 720. You're going to have reserves. So, it's not just about having the money for the house, but they want to see that you have 6 to 12 months of that mortgage payment in the bank. So if something happens, you lose a job, you've got money set aside to pay for it. So just a little bit stricter requirements. It's definitely not, something that just kind of eliminates everybody. But just know that if you're buying a property of that size, if a bank's going to lend you $800,000, they want to know that they're going to be taken care of.
Right.
So that's, expanded guidelines, but still very manageable. And, I feel like at that price point, a lot of folks have, their finances
figured out. You'd hope so. Yeah. If they're buying a house at that price.
Exactly.
Back in the day, people were doing something that was called 80/20s, where they're taking out a first mortgage and doing a second mortgage to buy the same house. Mm-hmm. Is that still a thing, or is that coming back?
It's not really a thing. There are some options like that out there, but traditionally, when you were buying with a single mortgage. A lot of times, the people did 80/20s back then for two reasons. Number one, there was 100% financing, which really doesn't exist anymore. Anything's going to have a down payment or down payment assistance or a grant. So people were doing that to do 100% financing, or they were doing it to avoid PMI, because they would take out that second mortgage, they'd be 80% on their first, and it worked out to be a slightly better payment. Now I think there have been so many improvements with programs that allow you to waive PMI that 80/20s and 80/10s and things like that just aren't necessary.
Yeah.
Nor would they be cost effective.
What's an ARM? I hear this term a lot around, and so what does a mortgage look like when it's an ARM?
So an ARM is an adjustable rate mortgage. Typically they come, the most common ones are 5, 7, and 10-year ARMs. And what that means is that you've got your fixed period, which is either the first 5, 7, or 10 years. Typically, they're based on a 30-year term. So your payment is based on something that's spread out over 30 years, but the interest rate is only fixed in for that certain amount of years.
Why would somebody want a loan that's only fixed for a certain amount of time? I thought, it was fixed for either 15 or 30. Why would you do a 5, 10, or 15-year?
So, for instance, I have a 5-year ARM on my house. I would never do a 30-year fix, but when I did my ARM a year ago, I didn't plan on keeping my home for longer than 5 years. You get better interest rates on the adjustable products. And so you have, the average person keeps a 30-year mortgage for 3 to 5 years.
Right.
So you have people that are paying this premium to lock in their interest rate for the entire time, but then they refinance or they sell or they do something else. So I love the ARM product. For me, I knew I wasn't going to keep my house longer than 5 years. So why would I pay an extra 0.5% on a 30-year fix when I know I'm going to sell in that amount of time? So I think, they're not for everybody.
They sound a little bit riskier than...
They are. There's definitely some risk, and so most people still stick with the traditional fixed rates. But I think they're good for people that, are looking to sell, people that know that they're going to maybe churn their mortgage a couple more times. Maybe you have a kid going to college in 3 years and you say, okay, I know I'm going to have to refinance and pull some equity out of my property. I'm going to do a 5-year right now. And then maybe I'll do the 30-year fixed on the next one. So there's, I think, it comes down to who you're working with and really evaluating your overall situation and figuring out what program is best for you. And even if it's, sometimes it's an ARM and a lot of times it's not. So.
Yeah. So it sounds like there's really a loan product out there for almost everybody, no matter what your financial situation is, as long as you have, above terrible credit score.
Yeah, above completely awful credit, then there's
I
something
apologize
out there.
now to anyone who has a below 500 FICO score.
But if you do, we can work on that too. So
Oh, you can?
Yeah. It's part of, again, working, when I talk to a client, I'm looking at their overall scenario, and I'm not only looking at what I can do for them now, I'm looking at what I can do for them down the road. So with my clients that can't qualify now, that means I'm looking at credit rescores and, advising them on what they can do to improve their credit quickly. And you'd be surprised because, I have clients that I talk to where I can bump them up 70 points, 80 points with them paying $300 on a credit card.
Wow.
So credit cards, if you're over 50% of the limit, for instance, it's negatively impacting your credit. So you can make a small payment to get it down below, and we can do a rescore that comes back in 2 days. And now you've got the credit score that I can use to qualify you.
That's crazy.
Yeah, it's incredible. And it's something that, I probably do one a week.
Wow.
for clients that I'm working with. So, and it can also get you to that next tier of pricing. Because
I was going to say, if you're raising your credit score by that many points, that could mean savings on an interest rate. That's huge.
It could give you, I have a client, because credit is tiered every 20 points. So somebody with a 699 credit is going to get worse pricing than somebody with 700. So if they're at a 699, let's say, and I can get them from 699 up to a 720, that could result in a 0.5% better on their interest rate. And, that on a, $200,000 loan could reduce their payment by $100 a month and allow them to buy another $50,000 in their house,
That's
so
insane.
Yeah. So there's, working with somebody that, is going to look at all angles for you, is really important, because you don't want somebody that's just going to look at what you have right now and say, okay, this is what I can give you. It's really about doing it, having that fiduciary duty to really advise your client to do the best thing for them, even if it means not getting the deal right then and having to do a little extra work in the process.
Kind of painting an overall financial picture of where those people are at and where they could be.
Exactly. I do the same thing for clients that are looking to retire. Retirement's something that I ask about because, if I have a client that's 15 years away from retirement, I might look at a 15-year fix for them instead of a 30-year, and maybe advise them that, hey, this is a better product based on your long-term goals. So really, you've got to look at that whole picture.
Wow, that's great. So let's say I've contacted you, I trust you, I've given you my information. How long does the process take from the moment I decide to go with you to the moment I'm in the house? What does that look like? So,
it depends on the client and depends on the process, but typically it's a 30 to 45 day process. If you've got somebody that's just a straight W-2 employee, salaried, with perfect credit, plenty of money in the bank, those clients obviously move a little bit faster. There's less conditions, but they could be buying a house that has a bunch of things come up on an inspection, so it really depends on the scenario, but typical escrow is 30 to 45 days. But we can rush things. We have loans that'll close in 2 weeks or even less than that if we need them to. But, we also have to have a client that's going to be proactive about, when I ask you for something, you've got to get it to me. If we're trying to close it in 2 weeks and you take 4 days to send me an updated bank statement, that's just not going to, that'll hold up the process.
Sure.
So.
What are some other things that can hold up the process? I mean, in the atmosphere that we find ourselves in, buyers are at a disadvantage. It's a seller's market, so buyers want to make themselves as attractive as possible. And I would think having a shorter close of escrow would do that.
Absolutely.
So what are some things that buyers or people often do that really slow the pace down from when they could actually close?
It's funny because a lot of it's common sense things, but you'll
it always is.
Yeah, and it's funny that this stuff comes up, but somebody that quits their job in process, decides to move to another company. Now we've got to verify the new income and wait for you to get 30 days worth of pay stubs. People that make a large purchase, they get excited and they're like, okay, well, I'm going to go out and, open up a new credit card at this furniture store because we're going to buy all this stuff. And well, now your credit took a hit, or now we have to explain that inquiry on your credit. So, it's a lot of, people that make large deposits into their bank account. I've had $2,000 sitting under my mattress. I'm going to go deposit it. Well, now we have to know where that came from.
Really?
Yes.
Wow. So it's not just negative things, positive things.
It's positive things. Any large deposits, and lenders have different requirements. Some of it's, anything over 500. Some of it's anything over, 1% of the loan amount. But it'll cause questions to come up. So the best thing to do when you're in process, keep your job. Don't make any large purchases. Try to just freeze your credit. Try not to apply for credit cards or anything like that, and try not to do anything major with your bank account. Lenders typically are verifying funds very, very close to when you're closing. And so, if you pull a lot of that money out to go do something, or if you deposit a lot of money in, aside from payroll and stuff like that, it's going to cause extra things to come up in process. So just be as conservative as possible with your finances, and you should be fine.
So just to review then, the things that you shouldn't do when you're trying to buy a home is change jobs. Mm-hmm. If you are going to be changing jobs, I would imagine letting you know ahead of time would probably be key.
Yep.
Not taking out any new forms or lines of credit.
Yep.
We constantly tell people, especially around like President's Day and Memorial Day, if you're shopping for a home, there's going to be amazing sales out there for refrigerators, washers and dryers, appliances. Don't take out any new debt.
Don't do it.
Are there any other things that people shouldn't do while they're in the loan process?
The bank statements are a big one. The three things that are looked at, are income, credit, and assets. So you don't want to change anything major with any of them. Those are your big ones, though.
Okay.
There's a few small things that that could come up, but for the most part, as long as you keep those frozen, keep your job, don't make any large purchases, don't use your credit for anything, I think you're going to be fine.
It reminds me of a story. We had a client, they were in the loan process, and part of her job, she was an office, manager. Mm-hmm. She'd go to the store and she would buy all the groceries for the office on a weekly basis, and then the company would pay her back every week. So she would put that on credit. Mm-hmm. And so she went and she bought, $2,000 worth of stuff for the office, put it on her credit card. It put her debt to income ratio over the top. Ugh. She couldn't qualify for the loan, so we had to wait until she got paid and reimbursed. It delayed the closing by like 2 weeks.
Yikes. And then the lender probably had to source where the reimbursement came from.
Yep.
So you have to get documentation from the company saying this was a reimbursement for these groceries. Just creates a whole laundry list of things that can come up. So, and a lot of it seems a little ridiculous. There's lenders can nitpick little things, but after the mortgage crash, everybody became very, very conservative. And I think a lot of that stuff is loosening up a little bit.
Oh, it for sure is.
It is. But it's still out there, and so I think it's better safe than sorry. I think, like with using credit, a lot of times lenders go off of the original credit report. So as long as you're not opening up a new debt, technically something may not come up, but it might, and so I think that, you just keep it where it's at, lay low. It's only 30 days, 45 days. You can hang out till then.
So in the atmosphere that we find ourselves in, where interest rates are going up, mm-hmm. When you qualify for your mortgage and you quote me a rate on the phone or in person or whatever, is that the rate that I'm guaranteed to have through the entire process, or is there something that I have to do to get that rate at the end?
So with a purchase, it's tough, because if you're getting pre-qualified, you may not buy a house for 3 months, and a lot can change in 3 months. So I think it's important to, be in touch with the lender that you're working with, kind of keep an eye on rates, because, they may pre-qualify you for, a certain rate that's giving you the ability to buy something, and you may look for something at the top of your budget. And if rates go up a little bit, that either means more money at closing to pay for that same rate, or that you can't buy as large of a house, So I think you want to keep in contact with your lender, and that way you have a good idea of where rates are at and how they fluctuate throughout process. With a refinance, typically you're locking in the rate up front. I think it's important to work with somebody that can lock your pricing. But there are things that can change that. If you have a low appraisal, come in, that will impact your interest rates and your costs for that rate. So, it's a little, it's easier to know that what you're getting on a refinance, assuming the appraisal comes in, but, things can still change and adjust it. So good.
So we've mentioned the word escrow a few times. Mm-hmm. What is escrow?
So escrow, when you're opening a contract, for a purchase, you are basically, you are working with your real estate agent to, to put together a purchase agreement. That's an accepted. Once you get an accepted purchase agreement, you are opening escrow, and you are typically putting down an earnest money deposit. You are basically saying, we've agreed on this price, and we are starting this process to go in. Close of escrow is when the contract closes. So you've gone through underwriting, the home's been appraised. If you had an inspection, if anything's come up there, that's been remedied, and you are closing escrow. You are going to the closing table and essentially closing on the transaction.
So then, what's an escrow account?
So escrow account also, sometimes it's referred to as an impound account. Mm-hmm. That's where you are including your taxes and your insurance in with your payment. So you can pay those separately on a conventional loan if you want to. Most people just like to have them included in the payment. They cut one check per month. They don't have to worry about a tax bill sneaking up on them, halfway through the year. So what'll happen is when you set up the loan, your lender is going to collect a certain amount of money to put into your new escrow account. And that's based on your tax and your insurance due dates.
Sure.
And then they, every month that you make a payment, you are paying 1/12 of the total amount. And then as tax bills come up through the year or a homeowner's bill comes up, they're using that money in that account to pay for it. If you do a refinance or if you sell your home, you'll get a refund of whatever that balance is because that's money you've just paid in that won't be used to pay taxes and insurance.
Okay. I just had a client recently. She posted on Facebook and I immediately called her, but she got a bill on top of her mortgage saying that there was not enough money in her escrow account. Mm-hmm. How does that happen? If they're collecting from you every month, how do they not know how much to get from you?
So there's a couple of different ways. Number one, you could have an increase in something. So lenders typically will verify, your homeowner's insurance, for instance. They'll verify once, maybe twice a year what that bill is. They'll verify it during the renewal, but also they're checking periodically to see if you still have it. Let's say you have a fire in your home. House burns down, gets rebuilt. Your homeowner's insurance premium might go up a little bit for that. Sure. But if the lender doesn't know, they're still collecting that old amount. So at the end of the year, when they have to cut that new check, there won't be enough in that account to pay for it. So what they'll typically do is they'll send you a bill and they'll say you have the option to either pay for this right now or we can spread it out over 12 payments.
It's nice they allow you to kind of divide it out if you need to.
Yeah, exactly. But there are some scenarios where, like if you purchase a new home, a lot of times, if the lender doesn't do their due diligence about what taxes are going to be and collect for that, they can collect on, maybe just the land tax value. And so if your taxes go from $300 because the previous year was just the land,
which is very common on new builds,
up to $2,000, now you've got this big escrow shortage. And if you're splitting up $1,700 over 12 months, you're talking almost $150 a month that your payment's going up. So
it could be a shock to get that bill in the mail.
Exactly. So, it's again, you want to work with somebody that's doing their due diligence up front, maybe estimating what the taxes are going to be. That way they're collecting enough in the beginning. And so you don't
They can always estimate low though, right?
They can, so things like that. And, unfortunately escrow shortages aren't uncommon, but in most cases, especially in Arizona where taxes are cheap, homeowners is cheap, it's not a big mess up. You have a $200 escrow shortage and your payment could go up $20 for a year. It's small. So
I got one and it was $7 difference a month.
I had one that was $16 total. So I just had to, so it's a small difference usually, but there are instances where it can be big.
So when I'm shopping for a mortgage, what would you say kind of are the average closing costs? What do those look like?
So with any mortgage, refinance or purchase, you typically have three types of costs. You've got your third-party costs, which is going to be your appraisal, your credit report, verifying your taxes, all these little fees that you're going to see on there. You've got your lender's origination. It's what the lender's actually charging you to do the loan. Some lenders charge 1%, some charge a flat fee. And then you've got your title work. So you've got, a title policy that's basically, on a refinance protecting the lender. When you're buying a house, you have a lender's and an owner's title policy. So you have two. So title can be a bit more expensive when you're buying. But those are your three main costs. Outside of that, there are what are called points that a lot of people hear of. And a lot of people, when they hear the word points, it's, I'm not paying points, and it's because they don't really understand them.
Well, I think points got a bad rap during the housing boom.
They did. Back in the day, when everybody had all of this equity most people paid points on everything because their house was going up by 10% a month. They didn't care if their costs were $10,000. It was just, I'll make that up next month. So people remember being charged all these points. And then when the housing crash happened and they lost a lot of their equity, some of that equity was eaten up by closing costs. So, but points can be a good thing. You can use points to buy down your interest rate. And you are basically paying an upfront fee that's tax deductible, just like regular interest is, to get a lower interest rate and pay less interest over the life of the loan. A point is 1% of your mortgage. So on a $200,000 loan, $2,000. And it's not going to reduce your interest rate 1 full point. You may pay a point and get a 3/8 of a percent reduction in your rate. So, and they don't always make sense for everybody. Like I said earlier, most people stay in their home or in their loan 3 to 5 years. Mm-hmm. So if you're investing a ton of cost and you end up refinancing 3 years later, you kind of wasted that money. So, what I do is I always, talk to the client about what their long-term goal is. Are you going to stay in this mortgage forever? Are you going to stay in this house forever? And really figure out whether or not paying points and buying down that interest rate makes sense. And, for someone that says, listen, I don't want to ever refinance again, they're going to carry me out of this place. It may make sense to invest a little more upfront and, get into a better rate because it's going to keep that payment down.
Can I get other people to pay my costs, points, closing costs?
Absolutely. In a purchase, you have seller's concessions. So you can go to the seller and have them pay a portion of the proceeds of the sale towards your cost. And that's pretty common.
I would say speak to your realtor about that on pretty common because it depends on the market that you find yourself in.
Exactly.
It's a seller's market right now for really anything sub $1 million, and trying to get sellers to pay for anything is really hard.
It's impossible out here. But I'm licensed in 30 states, so some states it's not the same right now.
Sure.
And so it's easier.
Even some cities in Maricopa County aren't the same. I would argue that, in the city of Surprise, it's very much not a seller's market and is more of either a balanced market or somewhat of a buyer's market because of the selection out there. So I think it even is different in Maricopa County.
Absolutely. So, it's talk to your real estate agent, and they'll advise you on the best way to go. And, that I think seller's concessions sometimes weaken your offer. So if you need to come in with something strong, may not be the best option or best thing to ask for.
Can I get someone else? Can the seller pay for my down payment?
No. Down payment. So, that can't come from the seller or the listing agent, your agent, anyone. It can't be borrowed. You can get gifts. So if you have a family member that wants to gift you funds, that's an option. There are other programs out there as well for, that you can do like down payment assistance, where they will give you the money and they'll put a lien on the property. And as long as you don't sell within 5 years, it's forgiven,
Is that like those grant programs that you hear about all the time?
There's a number of them out there and they're all structured differently. Some of them are just, straight gifts and you don't have to worry about it. Other ones, if you do sell before a specific time, they collect on it from the proceeds of the sale. But there are other options out there that will reduce your cost. So for instance, rates are on a sliding scale. The lower you go, the more you spend, like I said before, as far as paying points. Mm-hmm. The higher you go, you can actually get credits in the form of points.
Oh, wow.
And so those, let's say you qualify for a 4.5. But if you go up to a 5%, you might get 2% in credits, and you can use that to cover closing costs, money to put into your escrow account for taxes and insurance. So we will set up loans for clients that aren't necessarily getting down payment assistance. They're still putting their down payment down, but we will be able to cover all of their costs, all of their escrow. So it's literally just their down payment. And that eases things up.
That's fantastic.
If you're buying a $200,000 house and you've got a 3.5% down payment, you're only having to come up with $7,000 versus maybe 12 or 13 to pay cost and all of your escrow. So
we recently, within the last 6 months, even in this atmosphere, we helped a buyer. She bought a house. She qualified for a government grant program, so she had her entire down payment covered. Wow. We got the seller to cover all of her closing costs, and I negotiated 0 earnest deposit. Wow. So she literally came out of pocket, no money, and bought a house.
It's crazy. And that's out there, I mean, it's, I wouldn't say expect that, but there's definitely options like that. So, if you're willing to do some research into some of these programs and, work with lenders that offer them, and you've got a good seller, or a lender that's giving you some discounts, then, there's definitely options out there. So I would say if you don't have the money, don't let that steer you away from purchasing something. thing. Keep in mind that a house is expensive, so you don't want to be house poor. You know, you're going to get in there, you're going to have to furnish the place, things are going to break. You know, so I would say don't buy a house if you just have zero money, but you know, there are ways to do it with a lot less.
So say, okay, you've motivated me listening to you talk, and I don't have a ton of money, but I do want to buy a house. I don't think I'm quite there. I might be 6 months to a year out. What are some things that I can do right now to put me in a position to be able to buy a house in the future?
Okay. You know, first thing, keep an eye on your credit. You know, the big thing that impacts people's credit on a month-to-month basis is the proportion of their balances on their credit cards. You know, anything over 50% of the limit is going to have a negative impact on you. So, you know, try to keep those revolving debts in line, because you know, when you go to buy a property, you want to have the highest credit score possible. So being able to pay those down, you know, really monitor your credit, make sure there's, you know, you're not missing any bills that are going to pop up as a collection right at the end. So that's step one. That's a long-term play.
So I would suggest then pulling your credit now
Absolutely.
through one of the free services, right? I believe it's annualcreditreport.com, and
there's a number of them out there. You know, now keep in mind that a lot of the free services have different scoring models than what a lender pulls. So like if you look at your credit, you know, with Credit Karma, for instance, they have a 900-point scale. Whereas, you know, when we pull a credit report, it's an 850-point scale. So
I didn't know that. Where do they get 900 from?
I don't know. It's just a different scoring model. And so, you know, I'll have clients say, well, I'm at a 720 credit score, and I'll pull it up.
So shady.
It's just how it's reported, you know, and it's a lot of the online systems and like pulling it through your credit card, like Capital One, you know, for instance, you know, they offer a thing, you know, but it's not always accurate. So it's a good way to monitor your credit, but I wouldn't always rely on the score from that. But I mean, if you're doing the right things, I mean, you can't, even if it's an artificial score, you're not going to know what that score is until you really have a lender.
So would you suggest maybe even speaking to you now, even if you're a year or more out, and having someone like you look at your credit and tell you the things that you should be doing over the course of the next year to be ready?
100%. 100%. You know, you should always call a lender, you know, because they can pull up a credit report for you while you're on the phone, you know, and get you a good idea of what's on there, go through it with you, you know, so you know, if there's anything on there that's hurting you right now. You know, but if you don't want to do that, if you don't want somebody pulling your credit, you know, using those online resources are great. Just understand that the score may not be your true score when you go to qualify.
And then I just want to reiterate, what is the minimum down payment? I hear all the time from talking to people like, oh, I just don't have the 20% down that I need to buy a home. What is the minimum down payment requirement, of course, based on credit, that people need to have in order to qualify for a mortgage?
Okay. So typical down payment for FHA minimum is going to be 3.5%. You know, that's standardized FHA. That's how it is. VA, if you're a veteran, they do 100% financing, so there's no down payment if you don't want. And then with conventional, most conventional programs are going to require a 5% down at a minimum, but there are options out there that require 3%. And there's even one right now that offers a 1% down. So there are some unique programs out there. I would say if you're planning on going the conventional route, not FHA, try to have the 5%. You're going to get much better pricing.
Sure.
But you know, if you only have 1 or 3, there are options. So I would say no matter what your finances look like, if you're in the market to buy, you know, check it out with a lender and see what options you have. So at least you have a better idea of what you're doing going forward.
And then explain to me the difference between when you're quoting interest rates and then when I see what's called an APR.
APR is it's basically a reflection of cost. It's your annual percentage rate. And it's a good way to kind of compare lenders, because, you know, let's say if you're getting a 4% interest rate and your APR is also 4%, you're getting a free loan. And there are free loans out there. Like I said, you can go up in interest rate to offset cost. The wider the gap between your interest rate and your APR, the more cost basically you are paying on that loan. So if you're comparing identical programs and you have one lender offering you a 4% with a 4.4 APR and another lender offering you a 4% with a 4.7, this is typically going to be the better deal.
The 4.4 one.
The 4.4, yes. Okay. So you want to keep that APR as close to the interest rate as possible. Now, there's a few other things that impact it. When you pay mortgage insurance, like with FHA, that's going to widen that gap. But again, if you're comparing programs, it's really out there so you can compare two different things side by side and actually have an apples to apples comparison.
So we've gone through this entire process and we've gotten to closing. You were amazing. Thank you for helping me. Of
course.
And what can I expect now that the property has closed escrow? What's kind of the next steps?
So, your loan funds, that means funds have been wired out. The old loan is paid off. The title is clear. The seller is out of it. You're in the new loan. Your first payment usually will start. You'll have a month that you skip. Let's say you close this month in June. You typically won't make a payment in July. First payment will be August. Your lender is going to send you a statement, showing your monthly amount due. You can, with most lenders these days, you can set up auto pay. You can set up biweekly payments, which is always a good option. It cuts, 3 to 5 years off of your mortgage, depending on the scenario.
If you do a bi-weekly payment?
If you do it bi-weekly.
So that's paying making a mortgage payment twice a month?
So you're paying a half payment every 2 weeks.
Okay.
So most people are paid on a 2-week pay period. And so, doing a half payment every 2 weeks when they're paid versus one payment per month doesn't really feel like you're making anything additional. But what it boils down to is at the end of the year, you've made one extra full mortgage payment. And that can cut, years off of your term. So it can really accelerate, your equity, and help you pay the home off faster if that's a goal. And it's something that, the reason they design it is because it's something that most people don't even notice because they're just paying at their pay periods anyway.
Sure. So when I close my loan with my lender, are they going to be the ones that I consistently make my payments to?
Not always. So, you could be working with a brokerage or a correspondent lender like I am. I will tell you who your lender is up front. I know who we're going to take the loan through. But some people don't, they don't tell you that. And so, you'll get a surprise. You'll make 1 or 2 payments to the company you closed with, and all of a sudden you get a letter saying you've been transferred elsewhere. It's important to know about that up front, and that'll be on your loan estimate. It'll say we intend to service your loan or we intend to transfer it.
Okay.
Because, unfortunately, you could get transferred to a company that's, maybe a little behind the times in technology, and you have to actually mail a physical check in for your payment every month.
It's terrible.
I
don't even think
it's
I have
awful.
checks.
I honestly have clients that refinance away from companies because of that. They will pay closing costs to be able to get out of, a certain servicer because of all the headaches that it causes.
I think it's a lot cheaper to buy a box of checks than it is to refinance a loan.
It is. But, let's say you're working with a lender that, charges you to make payments over the phone, instead of sending in checks, or that you can't get a hold of or get a call back from.
That'd be frustrating.
Yeah. There's a lot of things that, people complain about with servicers. So, again, you want to work with a brokerage you trust that's going to take you through a good servicer that you're going to have a good experience with because, it's a long contract. So,
yeah. So if my loan is sold to another company, can they just decide to change my payment, change my rates, just change what my product is?
Nope, not at all. You are locked into that initial product. Now keep in mind your taxes can change. Obviously your taxes go up. They're going to collect for that higher amount. That's that. Your payment itself will not change on a fixed product. If you're in an adjustable, you've got 5 years. You go past that period, your rate is going to start to adjust, and so then your payment will change. But you are locked into that initial contract. And aside from things like with your escrow changing, what you signed up for in the beginning is what you get.
And can my loan be sold to different institutions multiple times?
Yeah. You'll have people that'll get sold 3 times in the first year, so it can get moved around a lot. It was really common shortly after 2008, after the mortgage crash. You had a lot of lenders that were going out of business, and so things were getting moved around. You had major lenders like Countrywide, for instance, that, completely vanished and were taken over by B of A. So, things, it can always be transferred. If you are delinquent on your mortgage, that's when a lot of people see their loans transferred because it's now a higher risk mortgage. And so it may go to a lender that, deals with specifically with that. So
that's a good point. You bring up delinquency. So when are mortgage payments due typically?
So every mortgage is the same for the most part. Your payment is due on the 1st. You have your grace period until the 15th or the 16th. But your mortgage is technically not delinquent until it goes 30 days past due, until you make it into in that next month. We give clients the option, for instance, if we have a loan that's in process where that we can't close in the first 2 weeks of the month, we'll say, well, we can close you later on in the month. You're going to pay a small late fee to your lender. $35, $50, but your mortgage is not considered late from a credit perspective, doesn't hurt you in any way. They can just charge you a fee after that.
I don't think I've ever made my mortgage payment on the first. I think I want to keep my money as long as possible.
Exactly.
So as a form of protest, I pay them on the 12th.
Yep, exactly. Well, I get paid, my commission comes out on the 15th. So I take full advantage of that grace period, So
Alyssa won't let me do that.
Really?
Yeah. She hates that we pay it on the 12th. She wants to pay it on the 1st, but I won that argument.
I have clients that are the same way. They're like, well, it's due on the 1st. I don't want it to be delinquent. Well, it's not going to be delinquent. So know that if you ever get in a bind, if it's, try to make your payment in the first 2 weeks, but if you're ever in a bind, you can make it later on. What's tough is that people start to get into the habit of making it later on because they say, okay, well, I'll just pay the fee every month. It's fine. And then they have something else comes up and then they can't make it on the 25th like they always do. And then it goes to the 2nd of the next month. Now you have a mortgage late. Your credit is trashed,
right?
And so try to make it in that first 2 weeks, but you have that as a backup option if you need to.
All right. So we've covered a lot of information. Is there anything that I didn't touch on or ask you that you think would be valuable for our audience?
Oh,
I know that's like a loaded question.
That is. That's tough. I mean, there's a million things that I could. I think I just want to reiterate. The biggest thing about this industry is working with somebody that you trust. Mortgage rates are set by the market. Costs are going to be pretty similar no matter who you work with. So, when you're looking for a mortgage, deal with somebody that really is going to take care of you, because the difference, in pricing between lenders is not going to be huge and not going to be worth it just to deal with somebody that you may or may not close your loan, you may or may not have a great experience with, won't, follow up with you. One thing that my company does very, very well and that I do well with all my past clients is I keep in touch. I want my clients to know when the market is moving. I want to, be able to tell them, hey, we can drop your interest rate 0.5% for free, and they don't always get that with a lot of people.
I don't think they get that hardly with anybody. I've never heard of a lender calling the owner of a home to let them know that they can bring their payment down for free.
Yeah. We have options where we will cover costs for past clients, and so it's something that we want to make sure our clients are always in the best spot possible. And, and keep in mind, I mean, it's not like we're not making money on that loan too. We get a new origination, but we can also help our clients, save some money on a monthly basis without adding money to their balance. And it's just a perk that we offer. And, also, things come up, things change. And so we want to, I want to talk to my clients if maybe they need cash out for something, and I want to be in their ear all the time. So if they need something with their mortgage or need money for something, I'm the one they talk to first, and I can advise them on the way to go with that. So,
yeah, I mean, do you want to share one of the perks that you decided you wanted to offer to some of our clients?
Absolutely. So, with,
this is an exclusive offer, people, too, by the way. This is just for Myriad Real Estate Group clients.
Absolutely. So I know that you're working on an option where you will cover, with a new buyer, $1,000 of their cost. We are actually working on an option to match that as well. And it was something that we just started talking about today. So I've still got to run it by the boss. But I think it's going to be, matching what they're going to offer. And, so that way, if you're selling your property and buying a new home, we can cover a majority of those costs and without even having to go up an interest rate like you would typically to get credits. So,
and we want to offer that mainly because we're finding that in this marketplace, it's so hard to get sellers to cover your closing costs. And asking for them is really hurting our clients in their ability to buy a house.
Absolutely.
So Garrett and I teaming up to be able to offer this to our buyer clients, I think is going to be huge, and really give them a competitive advantage to where they can still get some of their closing costs covered, but they're not going to have to ask the seller for it.
Absolutely. Yeah. Because, that's $2,000 off your closing. That's a big chunk of money, when you're already having to come up with a down payment and things like that. So it's, it's something that we're going to partner with Danny and do with all of our mutual clients, and hopefully it works out.
All right. Well, thank you so much, Garrett, for joining me today. If people want to reach out to you with additional questions or comments, or if they want to get pre-qualified for a loan or a refi, how do they contact you?
So you can call my direct line. It's area code 480-653-8763. You can also email me, gcerkvenik at jfqlending.com. It's a crazy
that
last
was a
name.
mouthful.
So
We will put that all in the show notes.
We'll flash that in the front here. Or you can go to our website, at jfqlending.com and reach out and let me know. And I'm happy to answer any questions, even if you're just looking for a free mortgage review. It doesn't hurt just to know that you're in the best spot possible right now.
Awesome.
And so if you're in a good rate, I'll tell you that. And if you're not, we'll work something out.
All right. Well, thank you so much, guys. This has been another great episode of Danny Brown Talks Phoenix. We'll see you in the next one.